Investing in stocks can be rewarding, but a multitude of mistakes can derail even well-intentioned investors. Here are 100 common errors to avoid. 1. Chasing hot tips. Acting on stock tips without verifying the information or conducting independent research often leads to losses. 2. Overtrading. Excessive buying and selling driven by impatience or the thrill of trading increases transaction costs and reduces returns. 3. Failure to diversify. Concentrating investments in a single stock or sector exposes your portfolio to unnecessary risk. 4. Ignoring fundamentals. Investing based solely on price movements or rumors without analyzing a company's financial health. 5. Panic selling. Reacting emotionally to market downturns and selling at a loss rather than waiting for a recovery. 6. Overconfidence. Believing you can consistently outperform the market without sufficient knowledge or experience. 7. Buying cheap stocks. Assuming low-priced stocks are undervalued without understanding their fundamentals. 8. Market timing, attempting to predict market tops and bottoms, which is nearly impossible and can result in missed opportunities. 9. Holding on to losers, refusing to sell a poorly performing stock due to emotional attachment or misplaced optimism. 10. Blindly. Following trends, jumping into popular stocks without understanding their risks or potential. 11. Ignoring taxes, failing to account for capital gains taxes, which can eat into profits. 12. Neglecting transaction costs, underestimating the impact of brokerage fees and other charges on overall returns. 13. Misusing leverage, borrowing to invest without fully understanding the risks involved. 14. Emotional decisions, allowing fear or greed to drive investment choices, often leading to poor timing and losses. 15. Lack of risk management, not setting stop-loss orders or having a clear exit strategy. 16. Overexposure to a single stock, placing too much faith in one company, regardless of its performance. 17. Ignoring macroeconomic trends, failing to consider how interest rates, inflation, or global events affect investments. 18. Speculating on penny stocks, investing in extremely low-priced stocks with high volatility and low liquidity. 19. Focusing solely on short-term gains, ignoring the benefits of long-term compounding for quick profits. 20. Overreacting to news, making rash decisions based on sensational headlines rather than in-depth analysis. 21. Following celebrity investors, copying famous investors' trades without understanding their strategy or risk tolerance. 22. Neglecting earnings reports, not reviewing quarterly and annual financial statements for insights into company performance. 23. Ignoring debt levels, overlooking a company's debt-to-equity ratio, which can signal financial instability. 24. Lack of education, investing without understanding stock market basics, valuation metrics, or financial ratios. 25. Falling for hype, getting swept up in speculative bubbles like meme stocks or cryptocurrency fads. 26. No clear goals, investing without a defined objective or timeline, leading to inconsistent strategies. 27. Relying solely on technical analysis, ignoring fundamentals while focusing exclusively on charts and patterns. 28. Ignoring insider activity, failing to monitor insider buying or selling, which can indicate confidence or concern. 29. No emergency fund, investing money needed for short-term expenses, leading to forced sales during downturns. 30. Overlooking competitors, ignoring how competition impacts the growth and profitability of the companies you invest in. 31. Misinterpreting P/E ratios, assuming a low price-to-earnings ratio always signals value, or a high ratio indicates overvaluation. 32. Focusing only on dividends, Prioritizing dividend yield without assessing a company's ability to sustain payments. 33. Not staying updated. Ignoring news or developments affecting your investments, such as regulatory changes or management shifts. 34. Investing without a plan. Operating without a written investment strategy can lead to impulsive decisions. 35. Ignoring economic cycles. Not recognizing how industries perform differently during various stages of the economic cycle. 36. Trading based on FOMO. Buying stocks out of fear of missing out, often at inflated prices. 37. Underestimating volatility. Investing in highly volatile stocks without understanding the risks or potential drawdowns. 38. Poor record keeping. Not tracking investment performance, which hinders learning from past mistakes. 39. Overlooking currency risks. Investing in foreign stocks without accounting for exchange rate fluctuations. 40. Ignoring regulatory risks, overlooking how changes in laws or policies can impact certain industries. 41. Falling for pump and dump schemes, being lured into artificially inflated stocks promoted by manipulators. 42. Not reinvesting dividends, failing to reinvest dividends, missing out on the power of compounding. 43. Ignoring share dilution, overlooking the impact of additional share issuance on earnings per share. 44. Investing based on hype, buying into overvalued stocks due to social media trends without due diligence. 45. Confusing price with value, assuming a low stock price indicates a bargain without evaluating intrinsic value. 46. Underestimating competition risk, ignoring how emerging competitors could disrupt a company's market position. 47. Skipping research on management, failing to assess the competence and track record of a company's leadership team. 48. Not monitoring industry trends, overlooking industry-specific developments that could affect a company's future prospects. 49. Holding on to winners for too long, refusing to take profits when a stock becomes overvalued. 50. Investing in overhyped IPOs, buying into newly listed companies without understanding their fundamentals or risks. 51. Ignoring share buybacks, not evaluating whether stock buybacks are beneficial or merely masking poor performance. 52. Investing without considering liquidity, buying illiquid stocks that are difficult to sell quickly at a fair price. 53. Neglecting seasonal factors, overlooking seasonal trends that can affect certain industries like retail or travel. 54. Failing to use limit orders, placing market orders and ending up paying more due to price fluctuations. 55. Investing in cyclical stocks without timing knowledge, misjudging the timing for buying and selling cyclical stocks. 56. Ignoring red flags in financial statements, overlooking warning signs like declining revenue or increasing debt. 57. Assuming past performance guarantees future results, believing a stock's historical success will always continue. 58. Investing based on emotional attachments, buying stocks of companies you like personally rather than evaluating their financial performance. 59. Underestimating political risks, failing to consider how political instability or policies could impact investments. 60. Ignoring the yield curve, overlooking the predictive power of the yield curve for economic recessions. 61. Buying stocks, just for stock splits, assuming stock splits inherently increase a company's value. 62. Neglecting exchange risks for foreign stocks, overlooking currency and geopolitical risks when investing internationally. 63. Investing in companies without moats, buying stocks in companies without competitive advantages, leaving them vulnerable to competitors. 64. Confusing turnarounds with traps, misinterpreting a struggling company as a turnaround opportunity without proper analysis. 65. Ignoring shareholder equity changes, overlooking shifts in